Alright folks, welcome back to Boss Economics World, the only show that peels back the layers of the global economic onion without shedding a single tear, unless you're looking at your 401k after a presidential tweet. It's September 12, 2025. The air in Madrid is thick with the smell of jamón ibérico, fine Rioja, and desperation. Yes, our favorite globetrotting financial firefighters are at it again. U.S. Treasury Secretary Scott Bessent is jetting off to meet Chinese Vice Premier He Lifeng. The official reason? To have candid and constructive conversations. Let's be brutally honest here. In diplomatic speak, candid and constructive is the equivalent of a married couple saying they had a productive discussion about who forgot to take out the trash. It means they yelled at each other but agreed not to file for divorce just yet, because the joint mortgage is too complicated to unravel. And what a complicated mortgage it is. On the table, we have a smorgasbord of geopolitical heartburn, trade, national security, the ghost of TikTok past, and a little something called combating money laundering, which is code for, hey China, can you please stop helping Russia dodge our financial bullets? This meeting isn't just a meeting. It's the pre-game show for the main event, the potential Super Bowl of symmetry, a face-to-face between a returned President Donald Trump and China's Xi Jinping. The groundwork is being laid, the red carpets are being vacuumed, and the world is holding its breath. But here at Boss Economics World, we don't hold our breath. We look at the balance sheet. We follow the capital, not the communiques. So today, we're going to dissect this Madrid mirage. We'll go from the point, this single meeting, to the surface, exposing the tectonic plates of economic power grinding against each other beneath the pleasantries. Forget the photo ops. This is the story of a global economic order in the throes of a chaotic, painful, and ridiculously profitable transformation. First, let's talk about the central narrative being pushed by the experts. Jeremy Chan at Eurasia Group says the main task is making progress toward a deal. A deal. That word should send a shiver down the spine of anyone who was conscious during Trump's first term. We've seen this movie before. It's Trade War, the sequel. The plot is predictable. The US threatens massive tariffs, China makes vague promises to buy more American soybeans and natural gas, a historic agreement is signed, the markets rally for about 48 hours, and then everyone realizes the fundamental issues haven't been touched. Let's look at the data from the last time they tried this. The Phase 1 deal of January 2020 saw China commit to purchasing an additional $200 billion in U.S. goods and services by the end of 2021. The result? According to the Peterson Institute for International Economics, China ended up buying only 57% of what it promised. It was a failure by its own metrics. Why? Because you can't command and control an economy to buy things it doesn't need at prices it doesn't want. Chinese soybean importers will buy from Brazil if it's cheaper and more efficient. Forcing them to buy American is like trying to force-feed a gourmet cat the cheap stuff from the can. They'll just turn their nose up and wait for you to leave. So, when we hear about a new deal, what are we really talking about? Trump gets a headline-grabbing win by pointing to a big purchase number. She gets a temporary reprieve from escalating tariffs, buying him time to further insulate the Chinese economy. It's a transactional, short-term patch on a gaping structural wound. The real flashpoint, the deadline that matters, isn't the summit, it's the expiration of the 90-day tariff truce in early November. This truce has kept a lid on a boiling pot. If it expires without a deal, we could see a return to the kind of across-the-board, 25% or higher tariffs that Trump has always favored. The IMF's 2024 report estimated that a full-blown escalation of the U.S. China trade war could shave as much as 1.2% off global GDP. That's not a haircut, that's a scalping. So, the Madrid meeting is a high-stakes poker game where one player wants to talk about a long-term strategic partnership, and the other just wants to take the pot and get a good soundbite for the evening news. Buried in the agenda is the fate of TikTok. And if you want to understand the entire US-China conflict in one, maddeningly addictive app, this is it. The deadline for ByteDance to sell TikTok's US operations is September 17th. This deadline has been pushed back more times than a failed tech startup's launch date. Why? Because this isn't a simple business transaction. It is a clash of civilizations played out in 60-second videos. For Washington, TikTok represents a three-pronged threat. 1. Data security, the fear that the personal data of over 170 million American users could be accessed by the Chinese government. It's the ultimate intelligence goldmine. 2. Algorithmic influence, the real crown jewel isn't the data, it's the algorithm. This For You page is one of the most powerful persuasion machines ever invented. The concern is that Beijing could subtly tweak it to promote propaganda, sow division, or influence elections. It's a soft power nuke. 3. Technological supremacy, for the first time, a Chinese tech company has created a global cultural phenomenon that outcompetes its American rivals on their own turf. For a nation built on innovation, this is an existential blow. For Beijing, forcing the sale of TikTok, especially its core algorithm, is a national humiliation. In 2020, they updated their export control laws specifically to cover algorithms, effectively giving the Chinese government veto power over any sale. They see the algorithm as a national strategic asset, and they are not giving it up. So we are at an impasse. The US demands a sale, but China won't allow the sale of the secret sauce. It's like saying, you can buy Coca-Cola, but you can't have the formula. What are you left with? Cans of brown, sugary water. The value is gone. This saga perfectly encapsulates the shift from a trade war to a tech war. The battleground is no longer shipping containers and ports, it's semiconductors, AI models, and data centers. The US has its CHIPS Act and export controls on advanced semiconductors, aimed at kneecapping China's technological ambitions. China is responding with a multi-hundred-billion-dollar push for self-sufficiency. The TikTok issue is the public-facing, pop-culture version of this deeper, far more consequential struggle. Its fate will tell us more about the real state of US-China relations than any trade deal ever could. Now, for the professionals in our audience, this is where the real money is moving. While the politicians are posturing in Madrid, CEOs and CFOs from Seattle to Shenzhen are playing a high-stakes game of global Jenga with their supply chains. The old buzzword was decoupling, a complete severing of the two economic behemoths. That was always a fantasy. The two economies are fused together like concrete. The U.S. Chamber of Commerce estimated that full decoupling could cost the U.S. economy $1 trillion in lost output. The new, smarter buzzword is de-risking. This is the China plus one strategy. It's not about leaving China, but about diversifying away from an over-reliance on it. The COVID-19 pandemic was the wake-up call, revealing the terrifying fragility of just-in-time supply chains. The geopolitical tensions are the permanent alarm bell that won't stop ringing. The data on this is staggering and tells the real story. Mexico is the new China. In 2023, for the first time in over 2 decades, Mexico surpassed China as the United States' top trading partner. In the first half of 2025, U.S. goods imports from Mexico are up another 8%, while imports from China have continued to fall, down 15% year over year. This is friendshoring or nearshoring in action. The rise of the new tigers, foreign direct investment into China has plummeted. In 2024, it hit a 30-year low. Where is that capital going? A significant portion is flooding into Southeast Asia and India. Vietnam's exports to the U.S. have tripled in the last 6 years. Apple, a company that was once the poster child for manufacturing in China, now produces all its iPhone 16 models for the Indian market in India and is rapidly scaling up production of MacBooks in Vietnam. China's strategic pivot, Beijing, isn't stupid. They see this happening. They are responding by moving up the value chain. They are no longer content to be the world's factory for cheap toys. They are aiming for dominance in electric vehicles, batteries, and renewable energy. BYD, a Chinese company, already surpassed Tesla in EV sales in the final quarter of 2023 and is expanding aggressively into Europe and Latin America. So, when Besant and he talk about economic issues, this is the subtext. The US is trying to build a new, more resilient economic bloc with its allies. China is trying to create its own sphere of influence through its Belt and Road Initiative and by becoming the indispensable supplier of the green technologies of the future. This is the great, messy, multi-trillion-dollar rewiring of the global economy. It's creating massive opportunities for countries like Mexico, Vietnam, and India, and enormous challenges for multinational corporations that have spent 30 years optimizing their supply chains for a world that no longer exists. Finally, let's touch on that seemingly boring agenda item, combating money laundering. As I said, this is code. It's about the weaponization of the US dollar and the growing rebellion against its dominance. When the US and its allies sanctioned Russia's central bank after the Ukraine invasion and kicked its banks out of the SWIFT messaging system, it was the financial equivalent of a nuclear option. It demonstrated the immense power Washington wields over the global financial system. But it also spooked every country that isn't a staunch US ally. For China, Brazil, Saudi Arabia, and others, the message was clear: if you cross Washington, you can be cut off from your own money. This has dramatically accelerated efforts to de-dollarize. This doesn't mean the dollar is going to collapse tomorrow. Let's be clear about that. The US dollar still accounts for about 59% of global foreign exchange reserves, according to the latest IMF data. But the trend is undeniable. That 59% figure is down from over 71% in the year 2000. It's a slow, steady leak. China and Russia now conduct over 90% of their trade in yuan or rubles. Saudi Arabia is openly discussing pricing oil sales to China in yuan. This would be a direct challenge to the petrodollar system that has underpinned the dollar's dominance since the 1970s. China is aggressively promoting its own cross-border payment system as an alternative to SWIFT. Its transaction volume grew by over 50% in 2024 alone. The mention of money laundering in the Madrid talks is the US subtly, or not so subtly, reminding China that it is watching how Chinese banks are facilitating trade with sanctioned entities in Russia and Iran. It's a shot across the bow in this emerging currency Cold War. The long-term implications are profound. A world with multiple reserve currencies would be more fragmented, potentially more volatile, and would strip the United States of its most powerful non-military weapon, the ability to control the plumbing of global finance. So, as we watch the news reports trickle out of Madrid, full of carefully worded diplomatic jargon, what should we, the smart money, actually be looking for? Forget the handshake. Forget the joint statement. That's the mirage. The reality is in the data. The real negotiation isn't happening in a Spanish palace, it's happening in boardrooms, on factory floors, and on trading desks around the world. Don't watch for a breakthrough on trade. Instead, watch the monthly U.S. trade data. Watch the shifting balance between Mexico and China. Don't wait for a press conference on TikTok. Watch the CFI-US filings and see if any American tech giant has the guts to buy a hollowed-out brand without its algorithmic soul. Don't listen to platitudes about stable supply chains. Watch the FDI flows. Track where Apple, Samsung, and Volkswagen are building their next billion-dollar factories. And don't get caught up in the talk of cooperation. Watch the central banks. Watch the percentage of global reserves held in dollars, euros, and yuan. That's the real scoreboard of geopolitical power. The meeting in Madrid is a symptom, not the cause. It's a reflection of two powers locked in an inescapable, deeply integrated rivalry. They can't live with each other, and they absolutely cannot live without each other. They are condemned to meet, to talk, to posture, and to manage a conflict that can never be truly solved, only contained. For now. That's the world we live in. It's messy, it's dangerous, but if you know where to look, it's also full of opportunity. Just don't get distracted by the political theater. Stay cynical, stay solvent. We'll see you next time on Boss Economics World.